Hello, and welcome to another video. So today we're talking about 5 things you should know about mistakes 401k investors make and how to avoid them. We have another coffee break for you. And if you don't know what that means, we'll get into that in a second. But if you're a returning viewer, we're so happy to have you back. Thank you for joining us again. Now, if you are new and you're saying, what is coffee break? This is what it is. So it's made for 401k participants. This is a short and sweet 15-minute max video. The whole idea is you're supposed to grab a cup of coffee. In my case, it's tea because it's afternoon and I cannot drink caffeine too late or I can't go to sleep. How about you? Are you in the same boat? Either way, whatever, grab a cup of something and get just a really quick sneak in a strategy or two that can help you in your journey to financial freedom. These are just highlights, of course. We are not talking about anybody's specific situation here. So if you have any questions about your specific instance or anything like that, there is going to be information at the end of the video where you can set up a complimentary consultation. Please feel free to take advantage of that. We're happy to help you in any way we can. Now, when I say we, I'm talking about Christopher Whalen and myself. I am Lisa Sakai, as you can see, and we're One Vision Retirement. So you can see we have lots of experience working with people. I tend to work with employees who use 401ks and company benefits to get them to financial freedom. And Chris tends to work with the business owner in putting a lot of these kind of plans in place. So we have you well covered. Okay, so let's jump into the 5 mistakes you might be making. So mistake number 1 is not increasing your contributions after raises. Now, I would say not just after raises, ever. So many people set either a percentage or traditionally just a flat amount, maybe $250 a month or something like that in their career, early in their careers, maybe in their 20s, early 30s, and they never revisit it. And so your income grows, but your savings rate stays the same. And if you get a raise, if you've significantly gone up in income, you might want to take a look at increasing just 1 to 2% possibly after a raise, after, a job change that you're getting a little higher salary. Those can significantly positively impact your retirement. And the savings rate is really what's going to get you there. So gradual increases often feel painless. Think about maybe possibly once a year looking at your savings rate and seeing if you can do a little bit better. My husband always makes a joke about how you play a game with yourself. And so see if you can challenge yourself to put away a little bit more. So just think small increases over time can create meaningful results in the long run. All right, mistake number 2 you might be making is trying to time the market. Now, some investors move money in and out of funds based off of headlines. I know some people go into their 401k almost on a daily basis to try to make changes, which I think for most people is probably too much. Selling during downtimes, doing the opposite of what we're taught to do, right? You're supposed to sell high and buy low, and people are selling low because they're fearful of things or whatever. And when you do that, you do lock in losses, whether or not you see the impact necessarily, because obviously in a 401k, you're not seeing any taxable impact or anything. You're not withdrawing anything. So you don't necessarily see that you're locking in losses, but you are. And you're missing market rebounds that can hurt for long-term growth. There is a graph that I will show, clients or prospects or people who have questions about this on if they miss just the top 10 days in the market per year, what does that do to their accounts? And it really significantly hurts them. So you want to look at your 401k as long-term benefits rather than trading in and out of the market really fast. I know that it has the tax benefit of not getting a bunch of capital gains in there and income, taxed income if you make a trade on a short basis and get gains that's counted as income if it's under a year and a day. Things like that. I understand it's tempting to do that in your 401k, but I would say for most people, your 401k should be that long-term benefit, the slow and steady wins the race, staying disciplined. Consistency in investing in your 401k usually beats market timing overall. And that's just the bottom line for especially for your 401k. So I would say hold off on trying to time the market, especially in your 401k, because most of the time it just doesn't work out for a lot of people. And I don't want you to be on that bad side of it, right? All right. Mistake number 3 is ignoring fees in the plan. So many participants never look at their fund expense ratios. And you can find that if you look at all the different funds, they list, I would say most of the time, if not, it might be mandatory now that they have to put that in there, the expense ratios. And that is the fee that the fund is charging you. They look at fees in their statements and things like that, but that's not counted necessarily on the statement, the expense ratio. So you want to see what those are. Those are small fee differences that can compound over decades. Some plans add lower cost, institutional funds. Some plans have very expensive funds in there. So you want to review what's available to you, what you're paying in fees, because fees matter more than most investors realize. So definitely take a look at your expense ratios, see what those look like. It's an average that you want to take a look at, but it's worth taking a look at, and also making sure sometimes in 401ks, because of a fiduciary matter for the business owner, the funds will change. So they'll change from this fund to this fund because it's offered, whatever the reason is that they make that change. And that fund that you get moved to that's supposed to be similar to the one that you were just in might be a lot more expensive, might be a lot less expensive. So it's really good to take a look at those expense ratios in there and take a look at your statements and make sure that you understand the fees you're paying, because you might be paying an advisor that you don't even realize is available to you to ask questions to. All right. Mistake number 4 is having too many overlapping funds. So oftentimes when I take a look at somebody's 401k, they'll have the target date fund, and then they have, 10 other funds that they're invested in. Now, I'm not saying that that's a horrible investment allocation, but you want to take a look at the target date fund first and see what funds are held in the target date fund. Because if you are holding them there, you don't necessarily want to hold them also outside of the target date fund. You're paying twice for it, and it's not as diversified as people think. So you want to take a look at what the target date fund holds, which funds are those, and are those also funds that you're holding outside? And you might want to make a switch or think about diversifying it a little bit more, because really you're not diversified if you're holding the same fund and twice. It's the same fund, right? It's doing the same thing. So a simpler allocation can often be easier to manage. More funds doesn't always mean better diversification. I know that that's what people feel like when they kind of I saw one person have every fund invested in their 401k. That was a long time ago, not a client. But that doesn't necessarily mean better diversification. So just know that, and really watch and see what you're actually invested in. That's important. And then number 5 is not understanding Roth versus traditional options. I'm still surprised to hear that people don't realize that they have a Roth 401k option available to them. Most plans do. I don't think it's required that they have to do it, but most plans have decided to have Roth options. And if your plan does, and you make over the amount of money that you can make to contribute to a Roth IRA outside of your plan, that might be of interest to you. So you want to take a look at Roth 401ks that are going to provide tax-free income later versus traditional contributions or traditional 401ks that are going to reduce taxes today. Sometimes that's just kind of a balancing act to see what that mix works for your tax planning now versus the future. Definitely talk to your tax professional when you're doing this. Have somebody looking at that if you're unsure, because you don't want to push yourself into the next tax bracket by putting too much into the Roth without knowing that you're doing that. If you make that choice, that's totally fine, but you want to know, you don't want some big surprise. So understanding tax treatment can improve long-term planning. I know many people say, well, this is an investment question. It is, though, because investment, it goes along with tax very much so. So I would say that this is definitely an investment mistake people are making. So, in conclusion, small decisions inside your 401k can have big long-term impact. Avoid these common mistakes. And instead of thinking these are small mistakes so they don't have an impact on my overall planning, that's not necessarily true. These little tweaks can be the difference between getting to your financial freedom goals faster versus not. So you want to take a look at this stuff. And you don't want to necessarily be chasing the perfect investment. That could change from time to time because you change, right? So the perfect investment when you're 20 is different than when you're 45 or 50, let's say. And then your 401k works best when it's part of a bigger retirement strategy. So often people will have things outside their 401k and all that. You want to see what all that looks like together. So that's the kind of thing that we do, but there are many other advisors out there that can help you take a look at the bigger plan. Also, there's tools possibly in your 401k portal that can help with that too if you want to do it on your own. Are those the most accurate? No, but it will at least give you a picture, which I think is better than nothing. So with that, here's the information that you can contact us with. You can open up your camera and just the camera app, use the QR code to schedule a meeting with us directly. You can write us at info@onevisionretire.com. Go to our website. We have plenty of resources up there. And I'm on LinkedIn quite a bit, so you can definitely check that out. Plus, you're probably on YouTube. We have tons of video on here too. So always feel free to watch any other video that is interesting to you. So with that, thank you so much for joining us. Hope this helped you, and we will be back next month with 5 more things that you should know. Bye-bye.